Hey, I'm Cameron with Check Bookkeeping. I work best with real estate investors, and I support real estate investors with virtual bookkeeping solutions. I am the person that ensures that your QuickBooks Online is optimized for your real estate investment strategy and to ensure you never have to worry about tax time. So bookkeeping and taxes go hand in hand. Bookkeeping is everything that leads up to tax time. Tax time is, you would meet with a tax planner quarterly to go over tax strategy at the end of the year to file your tax return. But in order for you to be able to do anything with taxes, you need to ensure that your bookkeeping records, your operational processes, all of that stuff is sound, so you're not running around scrambling, going crazy when it's time to file the taxes. So I support real estate investors with bookkeeping solutions. I do done for you bookkeeping, where I will be the person that goes into your QuickBooks Online account, ensure that all of the chart of accounts, all the files, and all of your transactions are properly coded and categorized. You get financial reports at the end of every month. And when you meet with a tax planner and tax preparer, you'll be able to have all of the financial statements that's needed in order for them to get the job done. So what I wanted to do today, I wanted to walk through what a balance sheet looks like for a flipping business. So real estate investing can branch out into many different categories. So you can be a house flipper, you can be a wholesaler, you can be a private money lender, you can have a rental portfolio, you can do BRRRR investing, creative financing. There's so many different avenues within real estate investing. And each specific type of real estate investor would need to look at specific items on their balance sheet. And it's extremely important that you understand, based on whichever niche that you're in within real estate investing, how you actually read a balance sheet. So we're going to look at house flippers. So house flippers are inventory heavy real estate investors. So they're basically handling construction. So they generally pick up a property, they buy a property, usually a distressed property. They buy it, they rehab it, they get it ready, make it look beautiful and livable. And either they would buy and hold it themselves and then rent it out, which is usually done via the BRRRR method, or they would flip it. So flipping it would be selling it to another investor. So it could be an investor that wants to buy and hold themselves. But they want to go through the whole work of doing the flip, so they would buy from a house flipper. So you need to ensure that your balance sheet is clean. So house flippers are balance sheet heavy. So you're really not going to be looking too much at the profit and loss for a flipping company. Profit and loss is really going to be extremely important when you actually finish the sale. So until you have sold the property and you've taken it out of inventory, everything must be held on your balance sheet. The only time your profit and loss would even be affected at all during a rehab process would be if you're incurring general expenses. Say you have payroll and you need to pay your office manager. So that would be a general expense, and that would have to flow through as a payroll expense through the profit and loss. But anything that's directly involved with the property, so any direct property costs, that has to be capitalized into inventory, which is what we call a work in progress account. And only then, after you've sold the property, then you'd be able to realize those costs of goods sold, gross profit, and that's when we start looking at the profit and loss. So balance sheet is extremely important through the entire process of your flipping business, and I'm going to show you what you need to look for. Okay, so this is the main page for the new version of QuickBooks Online. Some people like it, some people don't. I personally am not a big fan of it, and I haven't grown to love it too much yet. I prefer the old method, but we're going to look at this method now since a lot of users, if they just get QuickBooks, they're going to be seeing this interface. But I will give you a trick just in case you want to go into the old way. You could just log in to your QuickBooks, go to this gear icon here, get rid of this, and just click on switch, and it'll take you back to the previous version. This may soon will disappear because they're going to be migrating to this new version. But in the event, you want to go back to the old version, you can check on the gear to see if you have that available. Okay, so in order to get to the balance sheet, you need to go to the reports section. So there's a reports menu right here. You go to reports, go to standard reports, and it's going to give you all of the different reports that's available within your version. Okay, I'm gonna make this a little smaller. All right. All right, so at the top is going to be your favorites. So these are always like the default favorites. You can always change them if you scroll around and look at different reports. You can just add ones that you like, or you can just remove ones that you will never use or don't really want to use. So the one that we're looking at today is the balance sheet. So balance sheet is in its name. It needs to balance no matter what. It has to balance. So it will show you your assets, it'll show you your liabilities and your equity. So what does that mean? So the balance sheet goes by the accounting equation, which is assets equals liabilities plus equity. So assets is everything that the business owns. So that's your bank accounts, that's your inventory, your properties, and your liabilities will be everything that you owe. So that's going to be your credit cards, your loans, mortgages, conventional loans, private money loans. And then the equity is going to be everything that's left over. So that would be, your owner's draw accounts. So when you're taking money out of the business, it'll show there. Any owner's contributions. So when you're putting money into the business, it'll show there. If you have a partnership, it'll show all of the partner equities, all the, what equity each partner has within the business. It'll also show you your net income. So net income will be from your profit and loss. So that's all of your income minus your expenses. It'll yield you your net income. Your retained earnings. Your retained earnings is basically your net income from the previous year. It's just a carryover. So that's going to be your equity. So everything needs to balance for every business, no matter what. Assets will always equal to liabilities plus equity. So we're going to look at what a flip balance sheet would look like, what you would need to look for. So we're actually going to use a custom report, one that I've already prepared for this. So we'll look at that. So once that loads, so a balance sheet is always going to be as of the one particular day. So for a balance sheet for today, it's going to reflect everything as of today's date. So what does that mean? So it really means the day to is the most important part. Really, the day from doesn't matter. It's the day to. So if I go back, to the 13th, it's going to be whatever your balance is as of the 13th. Your balance sheet is cumulative. So it looks at everything that happened in the past, and it accounts for whatever happens in as of the present date. Okay, so we're going to look at today's balance sheet. On the top of the balance sheet is always going to be your assets. So your assets will be your bank accounts. It's going to be your cash on hand if you track petty cash. So this is going to be the current balance as of the 14th for what QuickBooks knows. So this will be anything that you've already categorized from the bank feed. It'll show up on this balance here. Next will be accounts receivable. Most flip companies wouldn't use accounts receivable because they're buying properties and then they're just selling the property. And the cash at closing is going to be realized. It's not going to be realized as an accounts receivable. Next will be your flip inventory. So this is your work in progress. So you have to categorize each specific item and category within certain buckets. And the main buckets that flip companies would look at will be the purchase price. So that's going to be the book value from the HUD statement when we first acquired property. So say we bought a distressed property for $260,000, then that will show up here based on whatever it says on the HUD statement. So it's going to go by the contract price. So this amount will never change. It'll always stay the same all the way up until it's being sold. Then next will be the buying and closing costs. That's all of the associated costs that's going to be on the HUD statement in addition to the purchase price. So that's going to be, your administrative costs, all of the costs that's going to be on the HUD statement in order for you to get the property at closing. All of that stuff needs to be capitalized as closing costs. Next will be selling costs. So selling costs will be at the very end when everything has been totally rehabbed and you are in a closing where you're selling the property to a buyer. So that's going to be all of the administrative costs that's on the HUD statement in order for you to sell the property. Those need to be capitalized, and then those are going to be immediately deducted as cost of goods sold when we process the actual HUD. Okay. So we would still be capitalizing those selling costs, but it's going to be extremely quick. Right afterwards, we're going to be cost of goods sold, expensing it out of the business. But it's important to capture those selling costs into WIP at the very end and then expense them out as COGS. So any loan interests and financing costs. So whenever we assume a loan, the origination fee, appraisal fee, all of that stuff should be capitalized as loan costs, financing costs. Those are supposed to be expensed out, amortized out throughout the life of the loan. But that can't be done because this property is not a finished product. So we have to capture all of the loan interests and costs into this bucket here. So as we are holding the property, we need to be able to collect all of those interest payments. All of that stuff needs to be capitalized into this account. And then we have to expense it out only after we have finished the inventory work in progress and we have sold the property. That's the only time that we can actually realize any of these expenses. So it's very important that we put all of the loan origination items, holding the loan, paying down the balances, the interest payments, interest expenses, all of that stuff needs to be capitalized into this work in progress. Then will be the holding costs. So holding costs is going to be all of the items and expenses just for holding the property. So it's not including any rehabbing. So after we've collected, we have the property, we've bought the property, we're doing the rehab work. So this is all of the costs that need to be incurred in order for us to keep the property. Okay. So this will be the insurance that we have to have, property insurance. This will be any, legal fees that we have to, permit fees, building permit fees. This can be utilities like electricity that we have to pay for in order for us to even just hold the property. So this is irrespective of the rehabbing. So this is all items that will also includes property taxes. So this will be rehabbing. You will be thinking of those as any repairs and any capex. Holding costs will be these are costs that you have to incur just to hold the property. So even if you weren't even doing any rehabbing, just holding the property, these would be the costs that you will put into this category. Okay. And then next will be rehab costs. So this is all of the work that you're putting into the property to get it beautified, to get it functional, to do capex work on it. So this will be electrical repairs, equipment rentals. This will be, purchasing new furniture, new drapes, new appliances, new refrigerator, stove, HVAC repairs, a new roof. This will also be repairs and maintenance that you have to do on the property as well. So all of that stuff needs to be capitalized into rehab costs. You can't assume any expenses until the property is complete and it's been sold. So those are the main components for flip inventory. So that's why it's extremely important to have a clean balance sheet, because once the property is sold, all of these items here are going to be expensed as cost of goods sold. So it's going to be a mirror image of the balance sheet. You're going to do a journal entry to show all of these amounts on the balance sheet, and then you're going to expense them out after you've also realized your flipping income. Okay, and then that's what's going to yield you your gross profit, and that's what you're going to be able to use to analyze how you've done in this flip project. So in addition to the inventory, we also will have to worry about any PITI escrows. So that's going to be if we have a loan and the lender required us to have a PITI escrow that we will have to that they're going to deduct from in order to pay any property taxes and insurance. We have to make sure we keep track of that, because that is considered our own money. It's just out of our control. It's an escrow. So we need to make sure that that's captured and reconciled appropriately. So that will really be it for any assets. We're not going to have any fixed assets because we're not going to have any buildings that we're able to depreciate, because it's not a finished product. Okay, so we have to make sure that we understand for a flipping business, everything is in inventory. So going to liabilities, that's where we're going to see our credit cards. We're going to see our hard money loan, private money loans, conventional loans, seller financing loans, all of the stuff that we have to pay in order to get the property. So this is all of our loans that we have. And then our equity, as we mentioned before, is going to be everything else that's left over. So the retained earnings is going to be everything from the previous year carried over. That's your net income from the previous year carried over. One thing we want to worry about will be for opening balance equity. Opening balance equity is something that we really should not see on our balance sheet. So we really would want to dig down into that. What usually would happen is opening balance equity will be, say, we started QuickBooks for January 1st of this year, but we were already in business from last year. So when we implement our accounts, like check accounts or credit cards, it needs to start at a certain point in time. So it's going to do opening balance equity. So best practice will be to, whenever you start off your QuickBooks and you bring your bank accounts, you would see the opening balance equity. You really should drill down into that opening balance equity and figure out where that money really should have come from. Most of the time, it's going to be like from an owner's investment. So it's basically like your own money. You would just put that as an owner's investment instead of an opening balance equity. A lot of CPAs and accountants don't like to see this line because it's not a true accounting line. So that's something to keep in mind of. So yeah, this is what a flip business balance sheet would look like. It's extremely important that it's clean and it's understandable. And yeah, so I mean, if you have any questions, please feel free to leave any questions in the comments. I'm always checking out the comments. Please feel free to subscribe to the channel. I'm going to be putting up a lot of other videos that's to help out real estate investors to really understand their financials and to show how important it is to have clean and accurate bookkeeping. In the event that you need any additional support with bookkeeping, I do have a bookkeeping business where I support real estate investors. I'm going to leave a link in the description below. I also have some free resources to help you out through your real estate bookkeeping journey. Please feel free to grab one of my free guides. And if you have any other further questions, I am happy to help and answer them. Thanks for watching.